With the holidays right around the corner, many of us are getting into the gifting spirit, whether that's gifting your time, your money, or your possessions. And whether or not you're motivated by making an impact or reducing your tax burden, there are different strategies in how to gift. So I'm going to walk through those three main strategies and the tax implications. Strategy number one is gifting appreciated shares of stock. So let's say you have an individual investment account or a joint investment account, and you own shares of a company that have gone up in value significantly. Rather than you liquidating and paying the capital gains tax, you can gift those shares to a charity and avoid paying the capital gains tax and be able to write off the full amount of the value of those funds. So this is a good strategy if you have shares of appreciated stock held in an after-tax account. Strategy number two is qualified charitable distributions, also known as QCDs. If you're 70 and a half years old and you also have a traditional IRA, you're eligible to donate up to $100,000 directly from your IRA to a charity and not have to pay income tax on that distribution. It's also especially useful if you are subject to RMDs or required minimum distributions. You can take part or all of that RMD out and donate it to a charity via a QCD and not have to pay income tax on that distribution, which therefore lowers your taxable income. The third strategy is donor-advised funds. When you contribute to a donor-advised fund, you get an immediate tax deduction in the current year, but you don't have to decide which charities it goes to until later on. So if you're still trying to figure out where you want to donate, a donor-advised fund is a good strategy if you're looking for a tax deduction in the current year. Another common strategy with donor-advised funds is you can bunch multiple years of contributions into one single year, which is a good strategy if you're in a high income or high earning year. There are some key considerations to keep in mind when you approach charitable giving. Number one is standard deduction versus itemized deduction. So to claim a charitable donation deduction, you have to itemize on your tax return. And if your itemized deductions are not greater than the standard deduction, it might not make sense to take the itemized deduction and therefore might not make sense to donate to a charity in the current year. Number two is there are certain restrictions on how much you can deduct based on your adjusted gross income or AGI. So if you're giving a cash donation, typically you're restricted to 60% of your AGI. And if you're gifting stocks, for example, typically you're restricted to 30% of your AGI. And lastly, timing does matter. So if you are in a high income or high earning year, strategies like bunching through a donor advised fund make a lot of sense. If you are in a low income year, it might make more sense to spread out your charitable contributions or wait and donate more when you're in a high earning year through the strategy of bunching. Charitable giving isn't just about supporting great causes. It can also be a smart financial strategy to not only lower your tax bill, but also create an impact. So if you have questions on which charitable giving strategy is best for you, we would love to chat with you.